Hi, everyone. Welcome to another show with Moomoo Singapore. We're live here from our office, but I know you're tuning in from in-app or YouTube. Anywhere you are, do come in and ask your questions because it's time to network. But before we begin, I'm your host, Olivia Higgins, and we are waiting for some people to join us. So here's a video crafted and created just for you. Enjoy. Welcome back, everyone. Happy Monday to everyone tuning in. We're live from Moomoo Singapore office, but today we've got an expert just for you to kick off our Moomoo Investment Outlook series for 2024. We're really on the way. It's fast forward to 2024 now because seriously, the last few weeks of the year are going to go by so quick. So it's important for you to learn new strategies that you can look at for the new year so that you can invest smarter together with us. So remember, before we begin, here's a reminder for you that today is not about recommendations or financial advice, okay? We're here to learn together. So do not take anything as gospel for yourself in your own financial journey, but a chance for you to network and to make sure that you make friends well within the communities because we are the bridge to access experts like we have today. So with that, let's jump straight to it. We're here in the new era of investing. We're going to fast forward to 2024 and look at the potential opportunities you need to know today, particularly for mobility innovation. So with that, I would love to invite for the first time on our show, Brett Kennedy, who is the Vice President of Intermediary Sales at BNY Mellon Investment Management. Hi, Brett. Welcome to the show.
Hi, Olivia, and thank you very much for having me today. As you say, the first time, so very excited. And thank you for calling me an expert. That's very kind.
Yes. Of course. I mean, you are the Kickstarter show for our audience, but for those of the people that don't know you, do give us an introduction about yourself and also the potential outlook and objective of today's topic, Brett.
Sure. So I'm Brett Kennedy. I work for BNY Mellon Investment Management based in Singapore, and I cover our Southeast Asian clients in the intermediary space. I've been with Bank of New York for 10 years, and I've been living in Singapore since 2017 now. So yeah, looking forward to it.
Great stuff. Now to everyone, this is the Kickstarter show for Moomoo Investment Outlook for 2024. Welcome to the people who just joined us. But before we go into our fireside chat, here is your also chance to earn some rewards from us. So we're going to thank you for being here on the live, but you've got to stay till the end because we got some surprise quizzes and giveaways for you. So make sure that you take your notes and make sure that you listen carefully to the sharing from Brett today. Now let's jump straight to it, Brett. The first question for you, what is BNY Mellon's outlook for next year, 2024?
Sure. So before I start the outlook, I'll just highlight what I think is the key messaging. You're talking about going into 2024. What I've been speaking to a lot of clients about in since the 2022 drawdowns is asset allocation and making sure you're getting that correct asset allocation. Because essentially we are going into an outlook that looks a little bit rocky, in our opinion. I would say we're a little bit more bearish than some of the other asset managers out there. We're putting around a 50% chance, or at least our base case currently is for recession. And there's a few reasons why. And I think if you could show slide 3 for me, there's a few little melting pots that we show on this slide. And the key ones for me really are the inflation remains persistent. If you think the US target number is 2%, although inflation is coming down, it's not reaching 2% anytime soon. So with persistent inflation, what does that mean? That means rates are going to stay higher for longer. That means companies cannot borrow to grow as quickly, and they're going to struggle with their balance sheets a little bit, right? They're going to have too much debt. So our view is those kind of two things will be sort of the key drivers and cause a bit more of a volatile market. And then obviously geopolitics. Geopolitics is pretty much impossible to forecast for all of us in asset management. That's just something we have to kind of deal with, and a shock that you may get. But we really don't know what's happening there. We've obviously seen two wars break out in the last 12 months or 18 months. China, there's still trade tensions and things. So inflation remains sticky. Rates will stay higher for longer. Potential for geopolitical shocks. So all in all, unfortunately, we are sort of saying a little bit more rocky going into next year. But that doesn't mean you sort of sit on the sidelines. It means you start thinking more carefully about what you do invest in, and hence we'll cover more about the asset allocation and things as we go through. But yeah, that's our outlook. Good, slightly unfortunate, but yeah, that's our outlook.
I know. I think the term unfortunate is also tied in with a lot of the user questions on uncertainty and also volatility. These are the terms that are writing out really on the audience platforms. But keep those questions coming, everyone. I know everyone's excited to know what are Brett's thoughts as well, and also BNY Mellon's perspective going into next year. So next question is, is it really about cash, bonds, or equity? I mean, which are the, indicators and also potentials that our audience members can look at in their current investment portfolio?
It's a good question, and honestly, it's one that is very difficult to answer. Look, we all invest, so I'm not a big fan of sitting in cash, but cash has been a very good investment for the last 12 months. But where do we go from here in terms of cash? We expect rates to be cut. So if you're still holding cash when these things start to happen, you could be a little bit late. So let's say the party, right? So I think cash is not terrible, and it should potentially make up part of your asset allocation as what I would call dry powder, but be ready to deploy that, when you think the stars are aligning for you. On the fixed income space, we prefer IG. Quite honestly, as I mentioned earlier, with rates where they are, we expect defaults to continue in the high, or to grow in the high yield space. So you're better to hide in the IG space, pick up your 6.5% yield that you get on an IG corporate. Rating of A, you do not have to worry about defaults. But what everyone is and I appreciate I'm not really giving cash, equity, or bond here, but what a lot of people have forgotten about over the last 12 months, even though equity markets have rallied, is equities over time are a very good investment. And I've got a couple of slides I'll show you, after in the next question. But if you look at slide 4, I think this really shows that actually asset allocation drives a lot of your return. So it's not about cash, bonds, and equities. It's about having your right asset allocation between the three of them, rather than picking just one and sitting there. And I think that's a very powerful slide. People think timing the market drives most of their returns, or picking the right stock or something. It's actually getting the mixture of the three right over time and moving that around dynamically. So unfortunately, a little bit more of a, let's say, a sit on the fence question between the three for your viewers. But it's about getting the combination of the three right. And my view now is, whatever you pick, make sure you're choosing quality. As I say, the defaults are up, balance sheets are going to be hurting companies and things. So quality is an underlying aspect there.
use the term when stars align for you. I really hope so, because, in terms of, we can just present the tools for them, right? At the end of the day, it lies within your hands, and, make sure that you really educate yourselves before you make that personal investment decision. Now, next question then, Brett, why not hide out in cash and bonds, since equities, we're talking about whether it's paying enough risk premium here.
Yeah.
What are some of your thoughts on that?
Yeah, so I was running the risk premium charts earlier. I mean, so the risk premium is corporate earnings essentially minus USD 10-year rates. And that is currently sitting at around 0.27, or 27 or 29. So in theory, you're not really getting paid for taking equity-like risk. You are, potentially better to be in cash and bonds. But if you look at slide 6 and 7, this is what I was saying, where the equities, even in today's market, can play a big part in your asset allocation. Equities has been the best performing stock through history, right? Best performing asset class through history. So I don't think, you can try and sit there in bonds and cash, because you could miss some of these rallies. I mean, even if you look back to the COVID crisis, how quickly the market just rallied, with the QE. And a lot of people missed that and then got in at the top and had some drawdowns. So it's very hard to try and gauge and time the market. And then you can see on slide, I think it's 7 on your pack, that these 3 charts showing if you miss the best 10 days, well, if you can time the best 10 days, clearly your returns are far superior. But one of our fund managers talks about the Big Short movie and how there's never been a sequel. In getting those calls right is very, very rare. Very, very specialist, and probably not for me, not something I could do. So I would prefer to sit on that middle line of, staying invested, getting better returns than not being invested. And, if you make some timing calls right, you may get them, but if you miss them, that's going to be detrimental to your overall return. So, so the 2-part question, probably equities are not currently paying enough. No, if you look at just today, but if you look at history, staying invested in equities, or at least having a portion of your portfolio in equities, does add return to you.
Mm-hmm. We mentioned earlier during the live that, the current sentiment really, the characteristics people use to describe it are like uncertainty, volatility. You even said, sometimes it's pretty unfortunate, right, looking at it right now. But what else would you say are the characteristics one should look forward to, right, when you're looking at a company next year, given today's outlook and given the characteristics that I just outlined?
Sure. So if we actually go a little bit further back, I think my view and the house view is that, investing between 2009 and probably 2020 was pretty easy. It was a period of time where pretty much everything you bought, bond, equity, any company, you probably made a bit of money, even crypto. Everything was going in the right direction. But if that is not normal market conditions, and we've seen with QT, and we've seen with higher rates, and when we talk about high rates, the rates today are actually not that much higher than what they have been through time. 0% is the abnormality here. So what it does is sort of takes you investing back, before 2008 and the kind of environment we had there, and that you've got to look for things like companies with barriers to entry. So these companies have been going, for 50 years. They're showing market share that the competitors can't come in and just sort of push them out the market. They've got good balance sheets. They can ride through storms. They're not going, have troubles if they need to sort of reinvest in their company. They've got that ability. What else are we looking for? Track record, of course. So again, going back to that tenure of a company, if that company can show it's had a track record for 15, 20, 35, 40 years, that's the kind of thing we like. Where we do not like is companies that are highly levered. I think they will struggle going forward personally. Companies that, and you might get the odd startup, you might get the odd IPO that does really, really well. But that's, if you're trying to build a core portfolio, that's not what we look for. I don't want to say boring companies, but potentially a little bit more structured, good management, proven track record, barriers to entry of their product, pricing power. Things like that is what we would look for in stocks today.
And would you say that's more on the stability side? I mean, you said boring, right? But what we're really looking at for right now is a little bit more certainty when we make a decision. Anything else to add to this point?
No, I agree. It's certainty. It's sort of, if you can look back at the fundamentals of a company and you can see what that company has done for 20, 30 years, and you think that can, or, the fundamentals say or show that that can continue to grow, that's what you're looking for. I personally, going into the market we are going into or have been in a little bit, I do not want to invest a big portion of my, portfolio into a company that I do not know what it's done for. I only know what it's done for 1 year. And I do not know what it's going to do in other market environments. So that's sort of, what our thesis and outlook, or what we are trying to find when we're picking companies for our portfolios today.
Thank you for that summary and also your additional insight for that. Now let's move forward to the fixed income space. Okay, what would you say are the variables that could make that space look attractive?
The variables.
Or any factors or characteristics that, an investor, an active investor, especially tuning in right now, what would they be looking at as an attractive component for fixed income?
Sure. So I think it goes back to sort of where, I mentioned high yield earlier and I mentioned IG. Yes, US treasuries, they even look pretty attractive rates these days if people want to sit there. But it's, they will be cut. Like, those rates will not stay where they are. The Fed have paused. I think we've got December's meeting on the 13th or 14th. If there's another pause there, I think that's, pretty good signal for everybody, that they're not going to need to go too much higher, maybe wait for another meeting or so. But in general, I think next year, general consensus from us and the market is there's some rate cuts. So if you start adding some duration to your portfolio, so our IG fund is A-rated, yield to maturity of 6.5% and about 6 years of duration. If you're looking in that space, defaults you don't have to worry about. You've got a nice yield, even if there is no rate cuts at all next year, you're still getting your 6.5%. But if you do get rate cuts, you've got, let's say, 1% of rate cuts at 6 years duration. That, to me, is a pretty attractive investment, given where we are today. And I'm looking, I think you've got the slide on the screen now. I can see it. Yeah. So if you look at where those rates are, that's a nice level. There's no equity premium or risk premium to me. That's kind of a good place to sort of sit into next year. And if they do start to cut rates, then I think your equity plays may start to play out towards the end of the year as well.
Thanks for that. So we talk about core portfolio or the strategic asset allocation here. Now, do tactical allocations still have a place in the current market situation?
Of course. The way I look at it depends on the investor and their, how they view or what they're trying to do with their money. Like, some investors will just sit in the, and I think it's on slide 12. Some people will just investors will just sit in the tactical space. And I guess that's, what I lean towards is slightly more gambling, and just taking those kind of high risk, high reward bets. That's fine if that's what someone wants to do with their portfolio. For us, it's more about building that core center. So you have your traditional asset classes, and as I say, you move around that asset allocation, and then you have your tactical bets or like your fun investing around it. Like, I don't think crypto or even mobility you mentioned should be everything in your portfolio, but they're your tactical bets that, they're going to be long-term growth themes, or you think you could time that or something like that. So definitely tactical still has a place. If you get tactical right, it can obviously, really improve your returns. But as I say, I'm just going back to where we are in the outlook we have. It's more getting your core right, I think, for the next few years, and having smaller tactical bets potentially than placing everything in the tactical side. And what I've seen when speaking to clients, and what came very abundantly clear in 2022, was everyone seems to be a lot more in the tactical ring, which I don't think you'll show. It's on slide 12, but everyone was in that tactical ring. They had a lot of tech, they had crypto, but nobody really had a fundamental portfolio. And then, bonds and equities all go down together, and everyone was sort of left out, hanging out to dry. If you have another shock like that, the idea, hopefully next time from this call and speaking to, your investment experts and things, that you can avoid that. You have your core and you build your tactical. And to me, that is how you sort of derive wealth for the long term, I guess.
I think the key word here is long-term, right? Long-term investors, a lot of them tuning in right now. So, we have some time for questions, okay, at the second half of today. But remember, during Brett's presentation, do pay attention to what he's sharing, because we'll have some surprise giveaways and quizzes throughout the show to reward you for being here with us. Now, to round up our chat, Brett, I've got a question about mobility and also, talking about the EV space. Now, in terms of industry going into next year's outlook, is mobility all about EVs, electric vehicles?
No, not at all. So we have our Mobility Innovation Fund, and I think that is a misconception. When people hear about mobility innovation, they think it's all about the electric cars. Obviously, Tesla, BYD, they might dominate the chat or what people see. But if you look, drone delivery is becoming a factor, hydrogen power for longer trips of aeroplanes, 24/7 autonomous freight driving is something that people are working towards. That connectivity to mobility is not just about the physical vehicles, it's about the connectivity to the roads, to the houses, to the people, how it will improve safety, how it improves efficiency. And really, if I think a lot of us, or if everyone who lives in Southeast Asia, I was just coming back from Bangkok last week, anyone that's been to Jakarta or anything, there's clearly mobility challenges in Southeast Asia abundantly. And it's not just about having electric cars that solves that, it's about infrastructure that helps to solve that. And this is one of the long-term growth themes. So we do have thematic themes at BNY, thematic funds. We try not to create anything too short-term, so we try to focus on the long-term thematics. And mobility innovation is one that we decided to run a fund on, because we just don't really see that going anywhere. I think it's 66% of people will live in cities by 2050. Something has to give. Either the mobility gets better, the people leave the cities, which I don't see happening. So something has to give, and therefore I think mobility certainly has a play, but certainly not pure EVs. No, definitely not.
Thank you for debunking some of the common misconceptions for this. Now, just to round up, because you brought up Southeast Asia, right? And you're talking about also the themes within the countries. But for the investors in Singapore, for example, you've got the Singapore Green Plan upcoming for 2030. And there's this huge movement towards not just making buildings sustainable, but also the EV space, right? Making it more accessible to the drivers here. Now, are there any additional thoughts on this, and how can they, what should they look out for perhaps next year for themselves, because of the two themes about connectivity and also infrastructure?
Is the COE on an electric vehicle still going to be 160,000? Because if that comes down, obviously that would be that'd be. So I think they are. You said it there, it's infrastructure, but infrastructure encompasses so much more than, just the buildings. It's the roads will, have to build, everything will have to improve in the infrastructure space. There'll be private companies that will emerge from this space. There'll be lots of IPOs, but there'll also be a lot of currently listed infrastructure winners as well. I think it's tough to really pinpoint something to look for, because I think it's so vast. But the infrastructure, and you've seen Singapore, the infrastructure is incredible, and it will only continue to grow. And I think anything in that space is potentially worth looking at for investment.
Right. And just to add on to your COE point, it's also the additional incentives that they can offer to the communities or the investors within the space, right? For example, for the road tax or anything to improve that accessibility to such components. So thank you, Brett, for highlighting that. Now, just to round out our discussions, any last points on mobility before we take some questions from the audience, and also for some surprise giveaways?
So when I've talked about mobility, and this was, this sort of leans a bit more on the electric cars, but when I first started talking about this product, I sit in there with my meeting clients and things, and I say, what car will you buy next? Will you buy a traditional car, or will you buy an EV with autonomous, which is all connected? And everyone obviously said the latter. And I think that just resonates with people, that when you actually think about what you will next consume, what that will be and what that will look like, then you break that down into components, then you can really see an investment opportunity there. And you think of the big screen you've got in there and how that's connected. You know, like it's sort of mind-blowing to me a little bit. But yeah, I think if you really sort of think about what you will buy as your end product, break that down into the components and make it, then you can really sort of start to see the investment opportunity there.
Thank you so much, Brett, for the fireside chat and also your insights related to this. We'll be back with you shortly, okay, for our live Q&A, because we've already got some burning questions just for you. So to everyone tuning in, I see new people coming in. Welcome. Once again, you're here on the first Kickstarter show live on Moomoo Investment Outlook for 2024. Now, if you want to watch the replay of this, don't worry. You can always watch that after the show ends, okay? But for now, I would like to reward you for the first quiz giveaway questions for everyone. So this is how it works, okay? The first 5 users who answer the questions correctly will be rewarded with 500 points in app, and you can redeem this with the details right here, and our team will be in touch with you, okay, if you actually get that. So with this, let us present question 1. If you're ready, type in yes. Type in yes in the chat box and we'll show you the question. And the question is in 3, 2, 1. Here's your first giveaway question for the day. Historically, which percentage of total return comes from market timing? You've got to give me the percentage and the exact number. Historically, what percentage of total return comes from market timing? Once again, fastest fingers first, and you've got to get it right. First 5 users, okay? All right, excellent. Looks like we have our winners. And the correct answer is, historically, 2% of total return comes from market timing. So congratulations to those who just won. And right now, if you have your Moomoo phones with you, everything, the app, everything up, follow me through with this short tutorial on how you can access and apply what you just learned today from Brett's insights, okay? So I've got my phone with me. It's up here. If you go to your phone opening page for the Moomoo app, this is how it should look. Okay. So this is the beginning. We've got Discover page, go to Funds on your tab. Under Funds, you go to Fund Houses. And for the purpose of today, we're going to use BNY Mellon. And you can see the amount of, I guess, you know, if for some of you ask how many funds are available on this, you can always access and see that on the app. Everything is available for you. And for the purpose of today, we're just going to use this since we talk so much about mobility. So if we click on BNY Mellon Mobility Innovation Fund as an example, you have all the tools here and indicators for yourself. So you can track the performance of this fund. You can see the latest NAV in USD right here. And if you go down, you can also see the trend and historical returns. So all of this is updated in real time, and you can actually adjust it for yourself. So I'm a very detailed person. For example, I need to know the exact details of every position, and that's just the kind of investor I am. So if you do want to see more of a macro perspective on every fund that you choose to engage, everything is here for you. If you want to see the position details, you can always tap the arrow on the right hand corner and everything is available for you. Now, also, if you want more functions like the comments on this particular fund, you can also go to comments, you can go to news, and you can track all the latest announcements related to this particular fund, okay? It's really important for you to really be in the know of everything, right? So if you do want to look at the last 2 tabs, you can also look at analysis right here. So you can see AUM, investment style, everything is all done and, really customized for you. So you really have to see what you prioritize in your own investment journeys, and then sort of figure out what tools you need for yourselves over here. Okay. So over here, for example, in summary, you can see under fact sheet the particular details of this. See, it just comes up straight away. And you can look at all the annual reports, semi-annual reports, all available and summarized just for you. So once you're done and you are ready to trade, you can always go down the bright orange right here and click on subscribe. Okay. So that's very straightforward for you. Once you click on subscribe, you'll just have to input the amount from your universal account. And that's it for the short tutorial. If you want to watch the replay, or if you have any questions for the product side of things, you can always drop us an email, which we will leave as well in the comment section. Thank you, everyone. Now, let's invite Brett back onto the floor because we have some burning questions for him. Welcome back, Brett. So I've got some questions related to, the small investors. Yeah. So people who are just starting, or people who don't feel like taking a huge risk at the moment for next year. So Brett, what are your insights on what they should look out for, and any tips when they're starting out on potential pitfalls to look out for next year? So Brett, we'll just have to get you to repeat that again because you're on mute.
Sorry about that.
No problem.
So it's what I would think is, if you're just starting out, obviously education, there's so much out there. Do try to educate yourself. Obviously your app looks great in terms of that. Learn what the fundamentals mean about any investment, because that's the key, right? See how much you can learn about any individual company at any time. But also, I think if you're just starting out, just accept that you're starting out. Realize that you are not the expert. Don't just go, oh, everybody's buying Tesla and go and buy it on sentiment. Try to sort of have a plan. Think about what you want to do with your money. As I say, build that asset allocation up over time. Maybe focus initially on the core and then start to build in your tactical plays. But yeah, really it is sort of, if you're just starting out, as we all were, as I was at some point, listen to others, learn as much as you can about the investment environment, the world we live in, and yeah, potentially just don't try and think you know it all straight away, because you don't.
Important point there. Absolutely, especially when you're just starting out, trying to drown out the buzz, right, on the particular news, or even what's trending at the moment. So always be careful and do your homework on that. Thank you so much, Brett, for that. Next question, given the macro outlook for 2024 and also based on BNY Mellon's perspective, how might an investor establish both a core portfolio and a tactical portfolio to optimize their long-term investment strategy? Let's say, this investor is looking at a time horizon of 20, 30 years.
Okay, so 20, 30 years is obviously a great time horizon to have. And that's a long time horizon. I think, your investment time horizon should maybe be sort of 5 years plus. 30 years is very hard to judge for. We really don't know where the world will be in 30 years. But there's some good products out there. 60-40, I think, did have a pretty challenging time, but once you have bonds and equity sell off, I think there is sort of 60-40s coming into play a little bit more. To build your core. I think the tactical really is a little bit more about what you're interested in. I'm not sure the tactical part is always about portfolio optimization, certainly not in my mind. That's where your core is done. And that sort of asset allocation we were talking about before. Obviously, tactical will have overlap and it does have a part to play, but I quite like to think with the tactical, maybe just have some fun, find things you're interested in. If you're really interested in crypto, that should not sit in your core portfolio. In my opinion, that sits with your tactical. And if you like that, I'm not saying don't play around and have fun with it. Just don't risk your entire net worth on on something like that. So it's quite tough to sort of say, 30 years, take that down to 5. How do you build it? Because it's very individual to each person. How do you do the optimization? I would try and do that more in the core. And again, that's, listen to your experts, listen to any advice you're receiving on where you should be moving, what part of fixed income, what part of equities at any time. And then tactical really is down to you. Have some fun, find what you're interested in. And hopefully some of those bets pay off for you, to be honest.
Yes, of course. We always wish our investors well. Now, the next question, and also the topic of today, once again, and we're really talking about prospering in this new era of investing. And with these new era trends, right, we're of course going to talk about AI. Now, we've got a question here on your thoughts on AI-focused companies in the current market conditions. Again, we're talking about uncertainty. We don't know what's going to happen next year. But with what you just shared on mobility, Brett, perhaps you could expand on your thoughts related to mobility AI focused companies.
Yeah, I mean, AI, honestly, Olivia, I find slightly scary. It's changing the world so much. We can't avoid it. I think it'll be ingrained in our lives forever. But see, similar to mobility, and when I was talking about sort of the end product, that's not always what you need to invest in, right? Like the end product's what everybody sees, and they're the companies you see. But actually, if you look at who's building those products and the supply chain of those products, and that's potentially what you could look at in the AI space, is not so much, who's creating the AI product, but first, how is it getting to that product within AI? I honestly don't know, but I'm sure there's lots of components and entities going into building that. But then it's about the companies that could be, really increase their revenues and their efficiency by adopting it. I honestly don't know who they are yet. I think some winners are emerging, and it's a space that I think people do have to follow very, very carefully. I mean, AI and mobility, to be more specific, is going to be huge. Autonomous driving, okay, of course. 24-hour freight is what I said. I think Elon's plan was for Tesla to be able to, for any owner of a Tesla to be able to rent out its Tesla to go and do Uber drives while they're asleep and make them some money. I mean, that's a scary world. So I think, it's limitless, really, what the AI can do. And again, it goes back to just making sure you sort of do your research on what specific of AI you want to invest in, how they be getting their revenues, how are they delivering them? What are they supporting? Has that company got a barriers into entry, pricing power, etc.? So just getting that supply chain correct, or that wealth chain, I think, is important to anyone looking at AI.
Thank you for that. Now, an extended question to that from someone in the audience is, do you suggest investors to look at what you just talked about? I mean, of course, but I think someone would like to know if it's too late, if they haven't invested in this space. And also, how does the fund come into play if they would like to really jump on the bandwagon of these trends?
So is this in mobility specifically?
In AI-focused companies.
Sure. Okay. Well, no, as I said, I think, at BNY, we try to focus on long-term trends. I think if you invest in short-term trends, they end up just becoming part of a global equity fund. That's my personal opinion. You have to find themes that really are, going to change the world and are going to need to be involved for 20, 30, 40, 50 years. As I said, there's lots and lots of challenges in the mobility space living in Southeast Asia. You get to see them pretty regularly if you do any travel. So no, I don't think that sort of ship has sailed or that boat has been missed. I still think there's lots and lots of opportunity there. And then within our fund, I mean, we have multiple analysts researching this space on a day-to-day basis to build our fund. One thing I do like about our fund is it has a private markets team. So we are continually analyzing the IPO companies before, so we know them when they get to market, so we can buy them. And we're doing that research for potential clients rather than you having to go and private market data is not that accessible. But when they think someone like a BNY fund will buy that company when it IPOs, funnily enough, they give us a bit of information to sort of share on their data protections and things. So I think that team is very important to the running of our fund. But I certainly don't think the opportunity has been missed at all. And if you look at the growth rates, even if you go back to EVs, I think by 2030, they're going to double triple or something. It's pretty crazy stuff.
Yeah, that's the plan. That's the plan for
That's the
sure.
plan.
So thank you, Brett, for taking some of the questions so far. But we're going to take a short break because now we're time for quiz 2 giveaway to everybody for rewarding you for being here with us. Okay, so you know the drill. The first 5 users who actually answer this correctly and also fastest fingers first will walk away with something from us. Okay, so if you're ready for quiz 2, again, type in yes. I want to see a big yes that you're ready in the chat box right now, okay? And we've got quiz 2 in 3, 2, 1. Between 2031 and 2040, what does Bloomberg suggest will be the total value of electric vehicles sold in US trillion? Have a think about this. You have to give us the exact number, okay? I'm going to give you just a little bit more time. I've got people already typing in. Again, between 2031 and 2040, what does Bloomberg suggest will be the total value of electric vehicles sold in US trillion? Give me the exact number. Okay, you've got 20 more seconds, everyone. Brett, what do you think? Do you think they got this?
I don't know if you showed the slide, Olivia, to be honest. If you didn't show the slide, it's going to be very hard for your...
I'm sure the team, yes, I think they have to be paying close attention to this.
Okay. Okay.
Okay. So we'll see if everyone got it. And the correct answer is, looks like we have our winners. The correct answer for this is 37.8. So congratulations to everyone who got this. The teams will be in touch, okay? All right, Brett, next question for Q&A. And that wasn't the last one. We still have a surprise giveaway at the end, okay? So stay on till the end of the show. Now, Brett, next question is really about asset allocation. I know we touched a little bit on this before, but maybe you could summarize for this new active investor right here. What is a good asset allocation from BNY Mellon's perspective, considering the uncertainties in 2024, and how can I manage risks related to the macro space? So it's a two-part question. Let's start with the asset allocation.
Let's start. Okay, so with the asset allocation, I'd sort of just run through a few things we like. In the equity space, although the US has got a little bit more expensive lately, we do tend to still favor the US. Now, Europe has started to look a bit more attractive, just certainly from a valuation standpoint, but there is obviously a few concerns. We think the US could potentially miss recession, whereas Europe is pretty much, at least having a technical recession. Asia, I still think has lots and lots of opportunities. So I'm just talking geographical here. But China, we still, unfortunately, remain a little bit uncertain on it. Now, China is not going to go away, so it really depends on your time horizon. I think if you were to buy China today or India today, you're going to make money down the line. That's personal view. Yeah, so we're more favored to US and Europe at the moment on equity. Core sectors as well, again, for your core portfolio. And then fixed income, as I said, IG bonds, potentially a bit of cash, some US treasuries sit in that space. We are not going high yield yet. I think high yield does have its place and it will have its moments, but currently with the where we are, we think high yield. And if you do really want to have high yield because the payoff is quite strong, focus on the double B portion potentially. Double P is just below investment grade, so your default rates there are a lot lower. So yeah, it's basically about putting your if I'm looking at building blocks equities, core sectors in the US and Europe at the moment. With I think Singapore is great as well actually. So if you want to buy in Singapore, we think that area is really strong. And then fixed income, most focused IG, US treasuries. That's where you're getting the yields at the moment. Singapore is paying, I think, 2% less than the US, so you may as well buy the US bond, right? So yeah, that's kind of where we are in terms of the asset allocation, risk mitigation. Just make sure you do your homework, pick the quality, as I say. Try and find quality. That's why we're sort of into large cap US and Europe, and then IG bonds, because I do think there's a lot of risk on the table for next sort of year at least.
Thanks for that, and also for your comprehensive answer summary for this two-part question. Keep those questions coming, everyone. We still have time for a few more. Next question. So in terms of a fundamental baseline portfolio, if I'm building that for next year, and since the focus is more on tactical, how would you say I can start off with that? I mean, other than the research component and also all the other points that we outlined.
Sorry, so just building a tactical portfolio, just that's tough. I wouldn't recommend it, to be honest. But if you just want to have some sort of small plays, as I say, then it's pick the big themes. Pick what you think is still going to be in vogue in 6, well, not even like 12, 2 years, 3 years. If you're only going to be making tactical calls, short-term sort of calls, then I think find it interesting, because then you'll want to research it, and you'll want to learn about it. And then just try to pick things that will, you think, are big thematics for the future. And ideally, don't invest 100% of your net worth in just tactical.
Thanks for that. Okay, next question. Small, mid cap stocks heading into next year. What is your outlook for that?
Yeah, I think, again, there's lots of opportunity in them. Historically, small mid caps will potentially, if you get them right, they have, a lot of upside potential. Look at the balance sheets of them. Look at what revenue they have been creating up to this point, because, if you've got a small mid cap that has made a bit of money in the last sort of 10 years, or 09 to 20, and then's been hanging on by a thread for the last couple of years at 5% rates, they're probably going to struggle. But there are some gems out there for sure. It's not a space that we don't look at. It's just, I think, as I was talking about, at the moment, given where we think the market is, we just prefer the qualities that some of these core blue chip or large cap companies are holding. But again, if you do want to allocate to small cap, small mid, there are opportunities there. Just make sure you've either got a good fund manager running the fund, or you're doing a lot of research.
Thank you. And I'm going to take 1 to 2 more questions, okay, before we do the final giveaway for everyone. Now, Brett, we've got some questions, looking at the potential risks geopolitically, and also, I guess, with the changes, like, for example, the US elections next year and everything, right? All these different factors that could affect the markets. Now, someone would like to know, what is the outlook for the potential pitfalls that they should look out for this space in particular? So they would like to know technology, energy, or mobility. How could that potentially affect these industries, and what should they look out for? I think this is a more risk-averse investor asking.
Yeah, sure. As I said, I mean, geopolitics is potentially the hard, like, people, you can't forecast it. You really can't. I don't think. It's very, very tough. And then obviously politics in general, if you're not even geopolitics, just like the US election, who knows? If Trump wins the election, or if who really knows what happens there?
You'll never know.
You never know. So it's very hard to try and gauge. It's a good question, and obviously everyone would love to have that crystal ball. But no, I think it just sounds a bit repetitive. But just back to making sure that you've got that quality in your portfolio, whether it be fixed income, equities, to kind of be able to weather any storms such as this. Because if there are big geopolitical shocks, you will start to see, and higher rates, you will start to see more defaults. And I just think that emphasis of quality in your portfolio is very, very important. I'm sorry, that's not probably the answer that the investor was looking for, but it's a very hard question to answer.
Of course. I mean, I think this is more related to that overarching theme of uncertainty that we were talking about. But I think just to really outline what the user is really asking for, Brett, here is how, all these components, not where it's going, but how could that potentially maybe affect the industries we were talking about? And also, I think you already outlined, ways to hedge against those risks, right? But do you have any other additional insights related to how that might affect the industries we're talking about? Let's talk about mobility.
Okay, so if you think just purely on mobility, obviously government legislation will have although I'm not sure, if you think about the mobility space, everyone seems to be pretty committed to growing it, and people do, whether it be the Democrats or Republicans in the US, I think those bills do not change. I think it is a problem in the States as it is in many places, and the governments are committed. That's something they tend to agree on. So I think mobility, as I said earlier, is a long-term theme, and they're the places you need to be where the governments do agree. Whether Trump comes, I don't think he might even spend a bit more. Who knows? He likes to spend money. But I don't think they're ever going to stop trying to improve their infrastructure from this point onwards. So yeah, that's I think mobility specifically, I think would be kind of well insulated from any shocks like that.
Thank you, Brett, for that. Okay, final question from the audience. So for the growth and value companies, right, what are the insights related to this going into next year? They just want to hear what is BNY Mellon's perspective on this related to the movements and cutting the rates further for next year, 2024.
So is this question growth versus value? Okay. I think markets are driven a lot more on sentiment these days than probably what I learned in my degrees and things. So I'm not to say value doesn't have a place per se, and I think there's some good value products out there. But I think personally, we prefer the quality growth space a little bit. You can get income as well. So there's sort of your value plays if you're getting a nice income. I think the rotations to value, if you look in the last few years, have been quite short-lived, and eventually growth does overtake. So trying to time that, as we go back to earlier, trying to time that would be very difficult, trying to switch between value and growth all the time. So I think it's sort of, you find where you sit in terms of your risk profile, and then you have X amount to growth stocks and you have X amount to value stocks, because that way, through the time when there are those rotations, you have something to buffer you up. But I think for me, I, at this moment, I guess it depends on your time horizon, like the quality growth a little bit more than the value as of today. But if you're 70, you might like value a little bit more.
Yes, absolutely. Dependent on where you are, your time horizon, your personality, and also all the other factors that you prioritize for yourself. Now, thank you, Brett, for really answering all those questions coming in from our live audience. We've got so many more, but that's all the time we have for today. Now, before we go into the final takeaway, here is your final quiz giveaway, everyone. Quiz 3. Now, if you're ready for quiz 3, again, you know the drill. First, fastest fingers first for 5 users, you'll walk away with something, okay? Type in yes once again so I know you're ready for this last question. And the question is in 3, 2, 1. Which is not a characteristic of a quality company? A, strong balance sheet, B, pricing power, C, barrier to entry, or D, highly aggressive growth? Which is not a characteristic of a quality company? As always, you guys are very fast with this. I'm just going to give a few more people chances on this question. Okay, and looks like we have our winners. Our teams will be in contact. The answer is D, highly aggressive growth. Congratulations to everyone. Now, Brett, while we round up our discussions, and thank you once again for being on the live, what is that final takeaway you have for our audience members today?
Okay. Volatile times ahead. it won't be the same as maybe the last, well, let's say 2009 to 2020. So be more careful, be more selective, look for more quality, and try and get your asset allocation a little bit more active, let's say, than potentially it has been where you've been overweight in certain places. Yeah, that would be it really.
And that was Vice President Brett Kennedy, everyone, from BNY Mellon Investment Management. Thank you, Brett, for being with us here today. We'll see you for the next show together. To everyone listening in, that was the first show kickstarting the series we have for you this week for our Moomoo Investment Outlook for 2024. We're only a few weeks away to the new year, but really, if you want to find out how you can follow us and also replay this particular live, if you joined in late, you can follow us right here if you're coming in from the app by scanning the QR code and also connecting with us with further questions that you have for our teams, whether it's product-wise or for our expert today, okay? So scan the QR code right here. And next up, if you want to stay connected on the other fronts, like the social media channels and also upcoming shows related to such topics, you can also reach out to me on the Moomoo platform if you want to see any particular guests on the show, if you want to see any particular topic. We're always listening to what you want to know, and therefore we always craft and curate content just for you. So scan the QR codes right here if you want to be on top of everything, and especially when we go live. I think that's very important. Scan it right now, everyone. And as promised, over here, we've got the client service email for you. Yeah. So for those of you who have further questions, you can always connect with our teams right here. They'll get back to you as soon as they can. And if you're around for part 2 of our Moomoo Investment Outlook series, this is the next topic happening soon. So if you want to find out more information, be sure to stay on the app and book in, notify yourselves when we go live tomorrow, okay? So we'll see you for the next show, everyone. I hope you have a great Monday ahead. We'll see you tomorrow. Tune into the show, okay? Make sure you book in. Once again, you're with me, Olivia Higgins. Happy investing. Okay, everyone can breathe. Okay, perfect. I think everything was pretty smooth. We have a lot of questions actually on YouTube as well. But Brett, for you, someone said very appreciative of all your insights.
Cool, good. Nice.
So thank you for helping our audience members today. We have a lot of people tune in, and we've got like super fans as well. So the fact that, you know, you're a new face as well, they're very excited for that. So hopefully we can do further next year.
Perfect. Thank you. Thanks for having us, Olivia and team. And yeah, next year.
Yeah, we'll be in touch with your teams for any follow-ups.
Great. Thanks very much.
Take care.
Take care. See you. Bye-bye.
Bye.
Bye.
Okay, team. Anything to note for our sides? I think we're pretty set, right? Everything is okay. It was pretty smooth. It was pretty smooth on this side, but just make sure that the